Right, folks, you've heard me talk about my buckets of money. Buckets of money is what my approach is to combating sequence of return risk. So I have bucket one money that is 4 years out of the stock markets in CDs, T bills, I bonds, money market funds, those kind of things that really safe liquid investment, 4 years. Then also let's skip bucket one, or let's go from bucket one to bucket three. Bucket three is 100% stock. Those are my growth stocks, all mutual funds, index funds. Okay, all equities. Sorry, I was searching for the word equities. Bucket two is money that I need in years 5, 6, 7, and 8. And I quickly jump over that and I say, hey, that's invested 60/40. So bucket one, 4 years, bucket two, 4 years, bucket three, money I start needing in year 9. Let's talk a little bit about bucket two. Why bucket two is 60/40? What gives me confidence there? Um, the intent is bucket two can handle a longer bear market. So if the market goes down by 40%, if it returns, goes from highs to valley to new highs in 4 years, bucket one does its job. What if you have a 5, 6, 7, 8 year bear market? Well, that's where bucket two comes in, and I use a 60/40 ratio of equities to bonds to for that purpose. Okay, so let's take a look at why. And for that detail, I'm going to go into Portfolio Visualizer, backtest portfolio asset allocation. It's a free um, tool that I use. So I'm going to share that screen. Give me a second here. There we go. Okay, I believe you can see my screen now. So here's Portfolio Visualizer, backtest portfolio asset allocation. So just type in Portfolio Visualizer, this will come up. Very simple to complete this form. I'm going back to, they got data back to 1985. Sometimes the funds, this is one of the cautions, the funds you use aren't that old. So you may say, I want to go back to 1985 and it starts at 93, it starts at 2010, something like that. So look at that. So I'm going 1993 in this analysis to 2023. I'm going to include year to date. It's December 2023. So yeah, there's a lot of data there. I got $1 million in there just for a round number, easy to be able to compare different options. I'm going to rebalance annually, okay, all these different options. And then we come down to my portfolio. The first one I'm calling the Wellington Fund. It's a Vanguard fund, been around for decades and decades. And the other one is a 60/40 total U.S. stock market and 40% short-term bond. So you can put whatever bond fund you want in there. I picked short-term bond. So what you do is you come in here, and here's the symbol for Wellington Fund, VWELX. I got 100% of that portfolio is in Wellington Fund. And then here's the VTSMX. It's got 60%. The VSHBX, I think that's a Fidelity fund I picked, is 40%. And both of those total to 100% allocation. So we're just going to compare portfolio one, which is going to be called Wellington. Portfolio two is going to be called 60/40. Hopefully this makes sense. And then I hit Analyze Portfolios. And it comes up and says, oh, it went back to January 93. This, like I said, this is really important to look at because you could be fooling yourself here. So let's take a look at the compound. This is a 30-year period now. Wellington Fund had a compounded annual growth rate of just over 9%, standard deviation almost 10. The 60/40 with rebalancing was less, 7.45 with a 9.2, and here it is shown graphically. So it says, hey, the managed Wellington Fund, which I believe has a 0.25 expense ratio, has done better. And this factors in expense ratio in the return. So that's pretty basic, simple analysis. Here's the annual returns graphically shown. But what I want to, and there's so many tools in here, I could spend an hour easy on this video. But what I want to draw your attention to right underneath the portfolios, you can hit exposures and it'll tell you by category, like here's large cap value, large cap growth, mid cap, small cap, emerging markets, corporate bonds, all that. It shows you where your two portfolios are. So this Wellington fund has a large cap value of 28.52%. Large cap growth at 23.63. It's got corporate bonds 15.15, sorry, and short-term treasuries. Okay, that makes it up. And then you can see the difference over here in this 60-40. The main things I see different, it's got some mid cap in it, it's got some small cap in it, and then also it's all short-term treasuries. The corporate bonds, the Wellington Fund, 15% is a big difference. So you can see the difference between different funds you want to compare and contrast. So that is really a cool feature. You can go into any metrics you want. I mean, I'll be honest, I don't look at that too much. It goes annual returns. So you can see all the annual returns of the Vanguard fund and then the total stock market one, short-term bond fund. Here they are combined, the 60-40. Monthly returns, assets. Here's the expense ratio, 20.25 for that. The other ones are lower. Okay. But today I want to draw your attention to something called rolling returns. And this is really what why bucket two. Okay, if you remember my bucket two money, I don't need through 4 years. So rolling returns, what that does is it takes like the month of November just last month, November, and adds that to the previous 35 months, comes up with a compounded annual growth rate for that 36-month period and plots that 1 point. So it's looking at 3-year increments, and then it also has 5-year increments going from 1993 through 2023 year to date. So rolling returns. So this doesn't look at just 1 year's worth of returns. It looks at the last 3. And then next month, it'll look at the last 3, advancing a month. And the next month, they'll look at the last 3, plot that point. So when you're looking at 3-year returns, take a look at this Wellington Fund, 3-year returns, the worst it's done in 30 years of individual months, looking back, 36 months, the worst it's done was 5.79%. But it actually averaged right at 9.4 and a high of 24. Now you jump into 5-year rolling returns, the worst it's done in 30 years is a minus 0.22%. That's pretty good. So when you're looking your risk, looking at history, no guarantee of the future, of 5-year rolling returns, looking at 5-year periods of time, the Wellington Fund essentially never lost money in 5 years. Okay. So huge. Okay. So let's look over at the 60-40. Its 3-year worst it's done is a minus 8.32. And the 5-year period minus 2.78. So pretty modest. That's the worst it's done. And then, averaged over 3 years, 7.76, over 5 years, 7.35. Hopefully I'm not confusing you right there, but let's look at this graphically. Again, annualized rolling 36-month returns. Okay, keep in mind, and I know this may be small if you're looking at your phone, right where my cursor is 0%. So this money that I have in bucket 2, I'm not trying to hit a home run with it, not trying to just get stellar returns, but want to get good returns and protect some of the downside. And it's very important to not touching this for 4 years. So you look at the 3 years, they just don't have a 3-year or 4-year rolling return. Okay, so I'm picking between 3 and 5. 3-year rolling returns it lost money. Well, actually, Wellington never lost money in this time period. The only time was the Great Financial Crisis was the only time that the Wellington Fund lost money, and it lost one time. One particular month, it lost rolling 3-year periods, one time in 30. That's a pretty good track record. This seems pretty safe to me to invest in bucket two because it's kind of unlikely it's going to lose money. If it does lose money, it's going to lose about 5%. And it's only done that in one rolling 3-year period. Now, the 60/40 with using the total stock market really had a second one. It had a pretty, got down to what, let's see, somewhere around -6, 7, almost 7% here in the dot-com crisis, and then it got down here to -6.3, minus 8.2 or 3.2 in the Great Financial Crisis. So it's a little more risky. This managed fund, they've got a long track record of protecting the downside and getting better returns. This is just data, okay? So that's 3 years. Now take a look at 5-year periods. Again, here's the zero line if you can't see well on your phone. And you'll see that the Wellington Fund, that's the blue one here, essentially never lost money in any 5-year rolling period going back to 1993. That's pretty good. And the 60/40 only lost one time in that during that time period and lost 3%. So 4%, 4 years rolling will be somewhere between 3 and 5. And where 3 on the Wellington Fund really doesn't only lost one time on a 3-year. On a 5-year, it essentially got down to 0 or minus 0.22. Let's get technical. So if I have 4 years of money in bucket 2 and I don't need that for 4 years, looking at history, it's unlikely that I will get negative returns and likely that I will get some fairly positive returns in the 7, 8% range. To me, that's pretty cool. Portfolio. Let's look at 3 years. Yeah, so the Wellington Fund, 3 years, 9.39, 5 years, 9. So it's a way that I feel because I got because my bucket 1 protects me. I can put money in bucket 2, get a decent return, protecting the downside based on history. So that's my logic. If you think I'm crazy, let me know in the comments. If you got a better idea, let me know in the comments. This is my 501st video, so we're starting the trek to 1,000. I'm not sure I'm going to get there, but I'm just going to make one video at a time. All right? It's Joe out.